So today on Toni Talks, I'm going to be joined by attorney Eliot Thomas and our bookkeeping manager, Troy Butler. We're going to be exploring the different types of business entities. So we're going to take a quick peek at limited liability companies, limited partnerships, C corporations, and S corporations. So let's just get into it. So today I want to talk about kind of exploring or looking at different business entity types. And I want to start with maybe the most versatile one, and that is the limited liability company, or LLC. And the reason why I say the LLC is versatile is because it can basically be any other entity type you want. If you want to run kind of through that.
Sure. Your limited liability company can be probably the most misunderstood disregarded. That just means that it doesn't file a tax return. It's not an S Corp, it's not a C Corp, it's not a partnership. It won't even file a return, but all of its information, its income, expenses will go on the return of the entity or person that's disregarded to. So that will be reported, but it just doesn't file its own return. Then the LLC can also, as I said, if there's two or more members, which are basically like the shareholders, but they're completely different. They call them members. If there's two or more, it could be a partnership, which files its own 1065 return, or an S corporation, which files an 1120S, or a C corporation, which files the 1120.
Well, going back just a smidge,
Yep.
When you set up an LLC with the state, you're filing articles of organization with the state, and the state recognizes the LLC as a business entity. The IRS, on the other hand, is, to your point, what is recognizing that, or not recognizing that LLC, and that's the term disregarded that you were talking about. If you have, and I like to kind of hone in on this point, because when you file with the IRS to get an EIN for the LLC, if you have one member or owner, the LLC is going to be automatically defaulted to disregarded. And if you have two or more members, the LLC is then automatically defaulted to be treated as a partnership. If you want to be treated as a C corporation or an S corporation, which is a very popular choice, or choices, you have to make a special election for that. If either one of you want to kind of go through what those special elections are.
That's the form 8832 you fill out, and you will tell the IRS how you want it to be taxed. So the IRS is very hands-off on it. Unless you choose to do nothing, and as Toni pointed out, then they'll tell you how it's taxed. Defaults to either disregarded or partnership, depending on the number of members. But you fill out the form, the 8832, and you can determine that it should be taxed as a partnership, or an S corporation, or a C corporation, and then you'll just carry out the business under that.
Well, can I talk about how the different type of taxes and how they're taxed for each type of the LLC?
Yes, absolutely. But real quick, I do want to point out that 8832 is going to give you C corporation status or partnership, or if you're already a partnership, you're going to disregard it. But to be treated as an S corporation, now you want to fill out the form 2553 to be treated as an S corporation. Throwing it back to you.
I'm sorry about that. Sorry to jump in. I got too excited there. If it's disregarded, it takes the shape of whatever it's disregarded to. So if it's disregarded to your personal return, you're going to report it on your 1040. If it's, like Eliot was saying, if it's two members and it's a partnership, you're going to have to fill out a form 1065. And how that is taxed is the income flows through via the K1 to the members.
And the K1 is kind of like a W-2, if you will.
Essentially the same thing. And there can be general and there can be limited partners as well. But that's typically on when you designate it as an LP. Traditionally, it just flows through to the two partners.
But that's a good point, because the limited partnership is a different type of entity, but it looks a lot like the LLC when we're talking about taxation, right? So if you are a managing member, that looks a lot like a general partner for purposes of taxes, because the income now is active to you. But if you're just a member, so maybe a limited partner, that acts as more passive income to you. So it mirrors, in a way, when you have an LLC versus an LP. But with an LLC, you can have the choice to hire a manager that's not a member of the LLC at all. So all of the members of the LLC can only be actively participating in the manner of hiring a manager, and they're just kind of hanging back on that investment.
Right.
What are some of the other highlights maybe of an LLC you would want to point out?
I think probably the besides just the tax status is the asset protection behind it. You are limited, as in its name, limited liability company. You're limited to just the amount that you've put into there. As a member, again, a member is the owner, if you will, and so the members are just limited to their own amounts that they put in. So that's the phrase limited liability.
So when I look at charging order protection for the LLC, I think the benefit of that is that the judgment or the creditor, they don't have a choice but for to stand in your shoes, basically, and they have to wait for you to, or the manager, to authorize a distribution for the creditor or for the judgment to be satisfied, and then that creditor is also going to have to pay the tax liability for any income generated in that period.
Correct. It's kind of a poison pill, makes it less likely that anybody would want to get tangled up with it in a lawsuit.
And charging order protection is not the only recourse in every state. That's why we do like states like Wyoming and Nevada that allow for you to have a stronger LLC in those states, right?
Correct.
So let's kind of pivot and talk about limited partnerships that you brought up a little bit ago. And the difference between the LLC and the limited partnership is, number one, small difference. You can set up an LLC with the state with just one person. But with the limited partnership, you can't file a limited partnership in the state with just one person. A limited partnership is a partnership. You have to have two or more people, and it has two fundamental positions, if you want to talk about that.
Yeah, it has to have a general partner, which is the one who takes on all the liability, basically, and any income earned from that will typically be active, whereas then you have the limited partner, which will be passive, and much like what we just talked about with the limited liability company, they have a limited liability themselves. That's the limited partner name. And usually what happens is all that income flows to them passively, which can be a good or a bad thing depending on tax planning, but it brings up a lot of issues that have to be looked at on your personal return and what our goals are as far as tax planning.
Now, I understand that the appeal of a limited partnership over an LLC is that the LLC is a little bit of a newer business entity type, whereas LPs are older, tried and true. Lots of case law as it relates to the limited partnership, so people like to stick with those. One of the things about the limited partnership that can be a bit of a challenge is you do have to have that general partner position, who the general partner is going to be wholly liable, whereas the limited partner, to your point, is only liable up to the amount that they contributed to that partnership. The way that we use limited partnerships at Anderson is we usually go ahead and put a C corporation in place to be that general partner, and that C corporation really only acts as almost just like a management corporation. So it's not there to run your investments or your assets, but rather they're just to manage the activities of that limited partnership or maybe other limited partnerships as well, right?
Correct. A C corporation will take the brunt, if you will, during a lawsuit. It has, and a C corporation is a perfect vehicle built for that, with the protections it has, whereas the limited partner will typically be much less exposed.
Now, we used limited partnerships, and we still do, quite a bit for holding, say, your brokerage account. And we used to like that because before the Tax Cuts and Jobs Act, we were able to deduct the 2% floor miscellaneous deduction, which included investment expenses. So we would go ahead and have the limited partnership pay a management fee to the C corporation, and then that management fee would be deductible to you personally when it flowed through to your personal tax return on your Schedule A. That has since been cut. We are not allowed to take that deduction anymore. We pivoted to do a guaranteed payment with the LLC. And the difficulty with the guaranteed payment in a limited partnership is if you're a limited partner, which the individual would be, and you wouldn't want to be anything else, you are going to be treated as a passive partner in nature, meaning that loss that flows through to you, so that guaranteed payment that flows through to you now as a deduction is going to be treated as a passive loss, which is not deductible against your active income. So the LLC started to look a lot more attractive, even though it's the teenager in the group. The LLC looks a lot more attractive now than the limited partnership.
That's correct. Like everything, all these have their individual tools in the toolbox. So there's times where we would still resort to the LP, but yes, the LLC is much more popular. We do a structure typically with 20% C corporation, 80% the individual as far as trading accounts, for example. That way we automatically shift income, and this would be in an LLC partnership, we automatically shift 20% of income off of the personal return into the C Corp, which has better deductions. And then also you can pay a guaranteed payment to that C corporation to shift even more of the income off of your personal return, again, into a vehicle, the C corporation, that has many more deductions that allow you to get some of that back to you tax-free.
So speaking of the C corporation, let's go ahead and take a quick look at those. C corporations are popular because they are actually a separate taxpayer. The C corporation income, unlike the LLC and the LP we were just talking about, well, unless you elect to have your LLC treated as a C corporation, that income does not flow through to you personally or flow through to whomever the owners are. The C corporation income is paid, or C corporation tax is paid at the C corporation level. But let's go ahead and attack the elephant in the room when we're talking about C corporations: double taxation.
Yeah.
We get that a lot. Why would I want a C corporation? I'm going to be hit with double taxation. Eliot, do you want to explain, or Troy, what double taxation actually is?
Sure. So on a C corp, it's hard to get money out of the corporation because it's all taxed on its own tax return at its own rate at a flat 21%. Now it used to be kind of like your personal.
We don't know what's going to happen next year.
Right. As of what's today, June 6th, 2020.
I'm a smart watch.
21%. But yeah, so you can't just take the money out because it has to stay in the corporation because it's its own individual thing. So one way to get the money out is to run payroll, right? But the problem with payroll is you have to pay payroll tax. You can also choose to take a dividend from the corporation as a shareholder. But the problem with that is then you're paying taxes on dividends. One of the tools that we use to kind of combat this is the loan from shareholder account. We can, if you paid for your health care premiums, your 280A meetings, anything like that, you can essentially reimburse yourself from the corporation,
right,
tax-free.
Right, and those are very powerful tools, very powerful things when it comes to a C corporation. I'm going to go back a little bit because I want to make sure people understand what happens with double taxation. The easiest way that I can think to kind of lay out how double taxation happens is if you take that dividend distribution as a shareholder from the corporation, it's not a deduction. Dividend distributions are not deductible to the corporation. So the corporation is going to pay tax on that income. And now you have taken a dividend distribution from the corporation. So now you are also going to pay tax at your tax rate, or at the long-term capital gains tax rate, rather, on that distribution. That's how double taxation happens. But it doesn't have to. It doesn't have to happen because of those two things that you mentioned there, payroll and shareholder loans, which I also include in that expense reimbursement. Or if you fall under a certain tax bracket, the first tax bracket, if I'm correct on that, the dividend distribution is taxed at what percent?
0%.
0%. So no double taxation on 3 fronts. So don't be intimidated by the C corporation merely because of the possibility of double taxation. You actually have to inflict that upon yourself. You can do the things that you were talking about, and I feel like that Troy was talking about. And I feel like the C corporation is a very powerful tool because it is an entity that does not have to prove that it is in business for a profit. It's not subject to the hobby loss rules. You can, it is a separate taxpayer. So you can set up an accountable plan and reimburse yourself as an officer of the corporation for those out-of-pocket expenses that you paid. If you want to give a few examples of that.
Yeah, certainly on the accountable plan, again, the way I like to look at an accountable plan, if you personally pay for something for the benefit of the corporation and it's for a reasonable business expense, then the corporation can reimburse you, pay you back, and it's not taxable to you, and it's a deduction to the corporation. And it really is a broad category. There's no end to it. I get asked, well, Eliot, do you have a list of, I couldn't possibly have a list. Our client down in Florida who has a fishing boat
We have a list.
is going to have far more deductions and different deductions for his fishing company than the client who's up in Colorado as a professional ski instructor. So there isn't any comprehensive list, but we do have a list of suggested deductions.
We do have a list of standard common deductions that we include when you do your Keep More Solution consult.
That's correct.
That Eliot actually does for you guys when you're a platinum member.
But one item on that, what I always remember is really what's happening here is we're seeing money come out of the corporation to you personally. The IRS just sees a dollar amount coming to you. They're going to naturally assume that's taxable wages. And so the accountable plan is you saying, now hold on, IRS, this is just a reimbursement. I shouldn't be taxed on it. So that means, well, we got to show the IRS something. That means documentation. We need to be filling out our documentation, turning in our reimbursement sheets, keeping the receipts, doing everything like that. Always billing back to the bookkeeping and making sure we're keeping good records of all of it.
Yeah, absolutely. And what are some of the kind of standard things that you see? Because at Anderson, we do have a lot of real estate investors, and that's a majority of the industry that we see, although we do have multiple. But what are some of the standard kind of expense reimbursements that you're seeing people pay out of pocket?
Sure. So we have a lot of clients that go to seminars and education events. So not only are the seminar costs deductible, so are your travel costs to these seminars. Your meals when you're there are deductible. Also, like we kind of touched on before, your healthcare reimbursements. You can have the corporation reimburse you for those. So yeah, these are all things that you can deduct.
And that's great. The medical reimbursement plan in a C corporation is awesome because health expenses, medical expenses is one of those things on the personal level that is allowable, but is highly limited. Whatever, the percentage is fluctuating to this year. Was it 10% floor now? There's a 10% floor when it comes to medical deductions on the personal return. So you have to look at your adjusted gross income and any medical expenses you had, or look at 10% of your adjusted gross income and any medical expenses you had in excess of that. That's what's allowable. So you're losing that out of the gate. But medical expenses are 100% deductible on the C corporation through your medical reimbursement plan, which If you have employees, it is worth it to note that if you have employees, you will have to offer that plan to those employees. And, I could talk all day about C corporations, but I do want to touch on now, if you have a C corporation and you file that Form 2553, now you can be treated as an S corporation. And the S corporation is kind of a hybrid between the best of the both worlds of a partnership and a C corporation. Partnership because it's a flow through now. So the S corporation income is flowing through, even though you can have one shareholder, you don't have to have two or more. But it is a flow through entity now, but it has some of the benefits that you get with a C corporation.
Correct. You get those corporate deductions, which we like on the tax side. You get the asset protection. You're a shareholder in a corporation, so you get corporate protection. And it does flow through, as Toni pointed out. So while it files its own tax return, it's all one that's going to end up on your 1040. And there's certain things that we can take advantage of that from a tax planning standpoint.
Absolutely. And amongst those are the most powerful to me in an S corporation is the fact that that S corporation flow through income is not subject to self-employment tax. However, the IRS is privy. They are fully aware of the fact that folks go out and get an S corporation so they can avoid self-employment tax, which is why they require you to pay yourself a reasonable salary from the S corporation. But you hold the cards. You determine what a reasonable salary is reasonably. So you're going to look at maybe something like salary.com or Glassdoor to see what the market rate is for the activities or the services you're providing to the S corporation, or you'll look at it from a percentage standpoint. I just say, if you're going percentage standpoint, as long as you're taking more out as a salary than you are as a distribution, you're probably in a good area.
Correct.
And just to touch on something you just mentioned, Toni, distributions is something you can do from an S corp. You can take money from the S corp. That's not taxable, as long as you have salary to be comparable. Otherwise, it can all be considered self-employment income.
Absolutely.
Yep.
Absolutely. And you also have to have stock basis in the S corporation. So in the C corporation, we're huge fans of going ahead and doing shareholder loans because you can just take that money back out as a repayment of that shareholder loan rather than trying to buy back stock, have the corporation buy back stock, which is paperwork and headaches. Whereas with the S corporation, you're taking the distribution. So we're proponents of you're going to buy stock to increase your stock basis and do additional paid-in capital to increase your stock basis and be able to just take that money out back as a distribution. That's not taxable because it's not in excess of your basis. Anything you wanted to add to that?
No, I think that's it.
So we can talk all day about this, and maybe I will do a deep dive into each and every one of these entities. But today, I really just wanted to kind of touch on all of them, scratch the surface, give you all something to think about. And if you want to discuss any of those entity types further with either one of these guys, you can give us a call and set up a consult. Thank you.